morning, everyone. So we just thought we should have a quick look at SPAR, given that they've reported recently for their first half of this year. Also, we've revised our intrinsic on that basis. So starting off with our executive summary, just to give a quick synopsis on our intrinsic. So the thesis is fundamentally based on us expecting softer sales in South Africa. And this is because consumers are opting for cheaper private brands, given the weaker economy. Secondly, in the offshore division, we're expecting margins to contract, given that they're coming off a higher base in 2022 from 2021. Thirdly, on Poland, we're expecting the company to break even in 2025, despite management guiding for FY23. So on the back of that, we're expecting our margins to contract on the top line, and as a result, we have since revised our intrinsic value downwards. I'll see it in the next couple of slides. So in terms of our pecking order, we have buy on SPAR, and this is because it's cheap, even though fundamentally this year it will still see some headwinds. And then we have a hold on Pick n Pay, as we're seeing a limited upside on our valuation. So in terms of the first half results, so their group sales were up 5.2%. So if we look at South Africa, they had strong sales growth there, where they were up around 8%. Like-for-like sales were also strong at around 8.5%, with volume recovering from last year's lows. So it was around 3.3%. Offshore remains under pressure, so Switzerland and Poland were down in rand terms, but Ireland still performed well. And then in terms of gross margins, they remained flat at around 11.9% compared to the 11.8% that we saw in the prior. Their profit, operating profit, was up 7%, and HEPS rose by 3.7%. And for the period, the dividend declined by around 38%. And this is on the back of them having revised their dividend cover, given that they're prioritizing SAP implementation all around the group. In terms of how the market reacted to these results, so it was a mixed reaction in that as much as there were some positives, but the market was more interested on that Poland turnaround story, and the company didn't really speak much on that. So on the back of that, then it was only up 0.8% on the day. If we look at how the company has performed to date, so it's been down 28.9% since our last report, and this is on the back of Poland having disappointed, because before the guidance was that they would break even this year, but they have since changed it now to 2023, but there isn't much color in terms of how they're tracking on that division as yet. And then in terms of earnings expectation, the market is expecting the mix to be more geared towards private brands. And this is because the company told us that in FY22, one of the reasons why they underperformed was because most of their suppliers were closed for private brands. So on the back of the looting that happened in KZN. So on the back of that, now the expectation is that this year we'll have the private brands dominating the mix, which would help to expand margins. So in terms of the like-for-like sales, we're expecting softer pricing from SPAR, and this is because they are fighting for their market share in the market. And on the back of that, volumes are expected to recover slightly to 0.6%. So in terms of where we think these volumes will come from, it's Woolies. I'm sure you've also seen the trading updates that have come out from ShopRite as well as Pick n Pay, that they've held their own. So I think the only other area where they can get the market share from is Woolies, given that in the Woolies trading update, their volumes are also down. So when you look at the valuation, like I've said, so we've revised our valuation down. And this is because for our base case scenario, we're expecting the margin top line to contract by around 100 basis points. So it will end at around 11.9%, down from 12%. And for EBIT to remain flat at 2.7%. And on that basis, then you have an intrinsic of around 169, 170 rather. And this is when we give a weighting that's geared towards the base case as opposed to the bull case scenario. I'll speak more to the assumptions on the next page. So in terms of the scenario analysis, so for our base case scenario, the main thing that we're factoring in there is the alcohol dilution, given that we know that alcohol has lower margins than the grocery division. Also, we think that pricing is limited for SPAR, given that their priority now is to recover in terms of the market share since they lost it the previous year. For the bull case scenario, the main assumption there is private brands contributing more to the product mix, and this will play out if the suppliers that were closed, they are actually fully operational in this period. And the reason why we've given this a lower percentage is because when we had a call with the management, we're rather not sure or convinced that they will actually be fully operational, those suppliers. And then for the base case scenario, this plays out if you have more alcohol in the product mix. And this is something that the management has highlighted as a key risk. So in terms of the peer comparison, so as you can see on the screen, you have your Pick n Pay screening better than SPAR for this year. But the reason why we have a buy on the stock on SPAR is because it's very cheap currently, and thus there's a higher upside that we're expecting compared to a Pick n Pay.